we saw a really huge improvement in the 10-year Treasury yield for the last 60 days. So it's okay to have this little, a burp or a market digestion or just a little time, the pause that refreshes, as Louis Navellier likes to say.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Happy New Year. Longhorns lost, but still went and tore it up on Bourbon Street afterwards. So rain in the new year. On to the next chapter. That's behind us. What's next? Deflation. That's what's next. And I know we talk about the 7 Ds here and all the life events, that help you have to get mortgages and make people go out and find new homes. But no one wants to talk about going through the big D. I don't mean Dallas, and don't want to go through deflation either. So I actually heard from one of my most respected sources today that I pay for, Louis Navellier's Platinum Growth Club. He talked about deflation. And he puts out like a fast market condition podcast every now and then. The stock market was going down today. We got like 3 or 4 trading sessions in a row. The stock market's going down. I'm not responsible for your losses, only your profits. I am not a financial advisor. But he was talking about deflation. And I love listening to some of the things he talks about. Just like I listen to, MBS Highway when I hear their podcast they put out. And so Louis was talking about deflation. China, 2 months in a row of deflation. Germany, 1 month of deflation. And so we are importing deflation. And that means slowing growth, which is not good for jobs, which, we have to talk about like when bad news is actually bad news. Right now, bad news is, okay, it's good for inflation. Inflation's coming down. We're having a mean reversion on the 10-year Treasury. We're getting our yields back down to a normal place, and interest rates in the mortgage business are coming down. And that's a good thing. But it's a good thing until it isn't. And so when there's so little growth and then we have job losses, that's when you have a real problem, and you have to reflate the non-growth in the economy. And that's when the Fed comes in. They've already said they're going to cut 75 basis points in the year of 2024. They said that on December 13th. That's without all the data that we're seeing this week. Jobs week. It is jobs week. We're getting ADP payroll out tomorrow, jobless claims, of course, every week. And then on Friday, the big one, the December BLS jobs report, the Bureau of Labor Statistics. There'll be a lot of information there. Wage growth, obviously the unemployment rate. Something like 160,000 jobs are anticipated. So less jobs being created, lower pace. There'll be multiple months now where there's less than 200,000 jobs created. And, the dynamics of the Fed funds rate that affect our economy are, they have a lag effect, but we all are feeling it, and especially on the lower demographics, the lower socioeconomic end of our country. Boomers, baby boomers, that generation has half this country's net worth, right? So there's like $150 trillion in net worth in America. They got 75 trillion of it, right? And so that's not to say that just because someone's a boomer that they're not feeling things out there, because they are. But they've had more time to create wealth. They've had more time to have equity in their home. There's $13 trillion in elderly owned equity. So, the HECM reverse mortgage is going to be very popular. The silver tsunami means 10,000 people aging into retirement. And so in the HECM world, the silver tsunami means these are borrowers that could tap their equity. Doesn't necessarily mean they're going to sell their house, but they could tap that equity. And if things are more expensive, then they may have to. If it is more expensive, just because inflation is slowing, it's still going up. So instead of going up at 9%, it's going up at like 2.5 or 3 or 2.5 or whatever that number is going to be to get to the Fed funds target rate. And those higher interest rates will hurt our economy, especially obviously for things that are more rate sensitive. 55% of all jobs created in America are done through small businesses. Well, they need capital. They got to get a loan. The loans are more expensive than they've been in a long time. Commercial real estate, they got to refinance these buildings. It's expensive. It's more expensive with the higher rates. Credit cards, student loan debt is out there. We know that's a huge headwind. Credit card debt, obviously we talk about it being up. Savings rate kind of down right now. Car loans, So when it's more expensive to have more credit, which is what keeps the machine going, you tend to have slowing economic growth. The Q3 GDP read, the final version was 4.9%. And typically in a recession, you see kind of a nice high GDP and then a drop off. Well, this week, the Atlanta Fed said that Q4, the GDP estimate that they have, is 2%. So it's down from their earlier estimate at 2.3%. So it went from 4.9 down to 2%. 2% is like a level economy. That's what they're saying for Q4 GDP this week. So Q4 GDP in a country where 70% of our consumer spending makes up for our GDP. Q4, when we spend like crazy on the holidays. I had a couple trips in December. The flights were kind of getting empty. And so the prices, you see the deals for airlines, it's always kind of like around this time of year. Feels a little different this year. And so remember, people have been spending a lot going out, experiences, travel. If that starts to come down, especially in Q1 and Q2, businesses have to make moves and they start cutting jobs. Our industry has already gone through our recession. Rates right now are lower and people are seeing more activity. They're looking, more people are back in the money. Takes a little time for that to materialize. Probably won't see it in January or February fundings. They go out, they look for houses, they look online, they trounce around in the cold and the snow, they get under contract, make their way to a loan, and then become a funding, let's say late February or March at best, right? But so we've already gone through our recession in housing. Manufacturing, full-blown recession, 14 months of negative growth. That's deflationary. That's not good. We're going to need at some point, and the Fed has already said it, more reflation of dollars getting circulated. We talk about the velocity of money. So when you see companies that continue to have these lag effects on these higher interest rates, high for longer, not higher, but high at this point, they will at some point impact job cuts. And so this is jobs week. It's important. We have a few more jobs weeks coming out before the next time we see a dot plot at the end of March, which, by the way, this week we saw the likelihood of a March Fed rate cut come down a little bit from like 74% to 68%. Now, part of that is because the 10-year yield went up, and I don't think that's really on trend. That's more just a market function, right? So, if you were in the FANG stocks, and again, I'm not a financial advisor, I'm not responsible for your losses, only your profits. If you were in the FANG stocks, which are some of the best businesses in the world, I mean, their cash flow is unbelievable, free-flowing cash, super profitable, loyal fan bases. I mean, you can't get someone off an iPhone. Like, you just can't get it. I mean, I feel sorry for you. You're trapped, but I get it, and you can't leave, and then you pay for all your stuff. I mean, that is a moat around that business. And so those are really well-run businesses. So people are selling those stocks right here in the first week of 2024 to take some profit. If you were on those stocks, you took some profit. So when you take profit, you don't have this week as opposed to last week. Your tax event isn't until April of 25. So it's a little bit of digestion, right? So we've had about 3 or 4 trading days in a row that were negative. We saw a really huge improvement in the 10-year Treasury yield for the last 60 days. So it's okay to have this little, a burp or a market digestion or just a little time, the pause that refreshes, as Louis Navier likes to say. So, will the market continue to go back on trend? This jobs report's pretty important to that. My guess is that it will. And remember, the Fed wants to, they don't want to make the same mistake that Volcker made and let rates go up too soon and reignite the genie out of the bottle for inflation. And so, inflation coming down is more purchasing power. Your dollar goes further for food and gas and everything else. But if you need credit to do things, it's harder because that's more expensive. And so 2% GDP in Q4, we'll see what Q1 and Q2 holds. The Fed has already said they think we're going to have 4.1% in unemployment rate this year. So that means there will be job losses coming. I don't know when. We're going to watch this data coming out. Housing initiatives this year, I think it's worth mentioning. I read the Potomac Partners, Brian Chappell's email he puts out. It's fantastic. Kind of summarize what we're looking at this year. Hey, HUD's got $145 billion, 10.5%. Capital Reserve, they only need 2%. So maybe we'll get another HUD MIP rate cut. I'm glad that they already, the life of the loan adds like 200 months of payments, the life of loan insurance. That's not good for someone buying a $300,000 house in low end. Fannie and Freddie coming down on the repurchases. That's good. The ratio of repurchases was high as 2009. We didn't have a credit collapse. We had a health crisis. So it's good to see Fannie and Freddie listening to the community, and that's been coming down. I noticed the numbers come out for that. CFPB, are they constitutional? They're funding. We'll see that. Burnett Sitzer, we'll find out what's going on there, and hopefully those dang pirates will stop the mess with our shipping commerce. Have a great week. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.